Hello, everybody. I'm Sam, and I want to say thank you so much for putting this together. It's been really fun to see everybody's research. Today, I'm going to be presenting my thesis, which is Mispricing and the Demand for Fundamental Information. And in my paper, the question that I'm looking at is whether mispricing affects the consumption of accounting information. And I think that this is a really interesting question. And one of the major roles of accounting information is to really help investors and to aid in valuation. And yet its ability to do so really depends on it being used. And studying information consumption in the context of mispricing, I think, is particularly interesting because this is a time when prices have deviated from fundamental value, and accounting information can provide kind of a stabilizing force. And it's also a time when the benefit of this consumption is actually quite high for investors. And this is something that we teach constantly in accounting courses, is that investors are using these fundamentals to value companies and to eliminate inefficiencies in the market. And despite that, there's very little causal evidence to kind of support these claims. And so I hope that my paper can add to this gap. Now, perhaps one of the reasons that there's not much data to support this is that empirically testing whether changes in prices drive information consumption faces a couple of key challenges. The first is that it's really difficult to observe investors' information consumption decisions. There's a lot of information available to them, and without serious big brother tactics, we can't really see what they're looking at. And then the second problem is that there's a lot of endogeneity in this setting. Anytime you work with market prices, this is a major issue. But particularly, teasing out the direction of this effect of information acquisition and changes in market prices is really tricky. And then you have the confounding aspect of firm fundamentals, which could be driving investors' decision to become informed, as well as changes in prices. So you may be, concerned that there's a large economic event that's driving both of these. So I'm going to use a setting which I hope allows me to overcome some of these challenges and add to this literature. So the first thing I'm going to do is use something called EDGAR. And this is going to allow me to obtain large-scale data on investors' actual use of accounting information by studying their downloads of accounting reports. And the second thing I'm going to do is focus on mutual fund flow-induced mispricing. Now, I know that this is like a mouthful, and I'm going to explain it here in a couple slides. But this is a form of mispricing in equity markets, which has been shown to be somewhat quasi-exogenous and non-fundamental in nature. So hopefully this will provide a shock to prices, which can help to alleviate some of these endogeneity concerns. So to talk a little bit about these mutual fund flows and this form of mispricing, suppose you have a mutual fund with a diversified portfolio of stocks. Now, these mutual funds obtain almost all of their capital from various investors. And at any point in time, these investors can choose to withdraw that capital. Now, if the amount that they take out of the mutual fund is sufficient, this can create kind of a liquidity shock for the mutual funds. And as a result, the mutual funds will have to offload some of their securities. Now, when these cash flow shocks are correlated across mutual funds, this can create substantial selling pressure in the underlying securities. And because these liquidity shocks are correlated across these mutual funds, there's a drying up of liquidity such that there can be a mass sell-off and there can be substantial price declines. So in my paper, I'm going to focus on these securities that experience the most mutual fund flow-driven price shifts. And these I'm going to refer to as fire sale firms, which is kind of following prior literature. So what this looks like, if you go within my sample, is I've computed the cumulative returns to holding a portfolio of these fire sale firms, where you have event time. The gray bar represents the event or period of the fire sale. And what you can see is that leading up to the fire sale, these market-adjusted returns are relatively unpredictable, and there's no indication of poor performance among these firms. But then at the time of the fire sale, because of this sell-off, there's a steep decline in prices, which then reverses out over the next 12 or so months. And because there's predictable reversals here, this is an indication that this is not due to changes in risk profile or something of that nature. Now, to measure information consumption, I'm going to use EDGAR. And for those of you who are not familiar with accounting, EDGAR is a repository which has all the filings that companies file with the SEC. And this is accessible by anyone. So anyone with a computer can go to EDGAR and search for different filings, corporate filings. And what happens is when the investor clicks or downloads one of these reports, this pings the EDGAR server, which records information about that request. And so in my paper, I obtained these Edgar server logs for a large period. And what this data looks like is it gives me an IP address, a timestamp, and then it gives me information about what company is being searched, as well as what particular filing they're looking at. And I'm going to compute my main measure of information consumption, which I'll call LNATT. And it's basically a count of the number of unique downloads that a firm receives in a given quarter. And some highlights of this Edgar data is it runs for about 15 years. It's about 400 million downloads and about 167,000 firm quarters. So it's quite substantial. And to give you a little preview of my findings, what I find is that mispricing triggers an increase in the consumption of accounting information. And again, I studied that by looking at fire sales and then looking at download behavior following the fire sale. And I find that this effect appears to be concentrated among institutional investors, and in particular, small, kind of specialized shops, and those that with less prior history or knowledge about the firm. And I'll talk a little bit more about why that's important here in a few slides. The next thing I look at is, okay, I've now documented an increase in the consumption. Does this lead to stabilization in equity markets? Does it force prices back to their equilibrium value? And I do find that information consumption following mispricing positively predicts price discovery. And the way I do this is, I look following a fire sale and I compute a measure of download intensity. And then I look at the return patterns. And I find that firms with the higher amounts of download intensity tend to outperform and recover faster than their counterparts. So let me talk a little bit through my thought process when I thought about some of these predictions. So the first prediction I have is that mispricing triggers an increase in the consumption of accounting information. And the reason why I think that this might occur kind of goes back to like financial statement analysis and the idea that these firms that are experiencing mispricing are going to be exhibiting certain signals. So perhaps the most obvious signal they're exhibiting is this price decline. However, there are several other signals that I investigate in the paper. And it's not so important what the signal is so much as that investors do observe it. Now, new specialized investors, when they're searching for profitable investments, are going to be drawn to these firms. And prior literature suggests that these types of investors, they tend to have limited resources, so they're unlikely to be informed about all firms at a given point in time, and that they can use accounting information to optimize their investments. Now, I don't think that this prediction is without tension. I think that alternatively, you could imagine a world where mispricing triggers trading behavior without going out and getting the accounting information. If you think a firm is mispriced, perhaps you trade directly. And then also, there's a lot of information out there, perhaps more timely than accounting information. So you could actually imagine a shift in attention away from accounting information and to more relevant, timely economic information. So what I do to test this is I look at the leading attention or attention in the period following the fire sale, and I run this in first differences, which I hope allows me to accomplish two things. One, it allows me to control for some of the serial correlation in the data, and it also allows me to scale and study in approximate percent changes, which is useful. And I predict that this increase will result in kind of a positive coefficient on these fire sale variable. And this is precisely what I find. In fact, I find that following a fire sale, information consumption increases by about 1.36%. And in economic terms, this is about 24 additional downloads, which this may seem small initially, but compared to one of the more important events in a firm's life, which is the earnings announcement, it's about 18% of the effect of an earnings announcement. Now, I want to test more directly whether mispricing attracts specialized investors. So if you remember, the mechanism I had in mind was to target a specific type of investor. So what I do in my data is I revisit this, and using the IP address, I'm able to match these to specific organizations and classify firms as institutional investors or searchers as institutional or retail. And I find that the effect is concentrated among institutional investors, consistent with this mechanism. I also find that it's within this bucket, it's concentrated among investors with less prior search history and investors or institutions with small amounts of holdings, which more likely represent specialized shops. Now, for the back end of the paper, I look at this positive relationship between information consumption and price discovery. And the reason why I think that this is the case is that as investors are drawn to and consume accounting information, there's an increased likelihood of identifying these undervalued firms. And this could help to lead to trade and liquidity provision and hopefully alleviate some of the mispricing. So what I have in mind is, if you recall the shape of these fire sale returns, looking at download behavior in the period following the fire sale, classifying firms as high download and low download firms. And my thought process is that these high download firms will recover kind of more quickly. So I test this in a few different ways in the paper. I look at the return patterns following the fire sale. I use a hazard model to estimate, the likelihood of full recovery within different time windows. And I use IPT, which has been used in prior literature to study area under the curve. And I find results to support this hypothesis in each of these. However, I think the easiest way to look at this is to just plot this over time. And so here is kind of a central figure of the paper where I look at the fire sale. These are all fire sale firms, but stratified by download intensity. And you can see that pre-fire sale, each of these firms kind of exhibit similar return patterns. They each, during the time of the fire sale, have significant price decline. However, the solid bar, which represents the high download firms, tends to recover more quickly and more timely. And this can be really valuable to the firm as it helps to alleviate undervaluation, which can have some kind of negative externalities for the firm. So to wrap up, I provide some evidence that I think is missing in the literature of what drives investors to consume accounting information and how this can help to play a role in security markets. And in particular, how it can help whenever there's noise in security markets, how accounting information can provide kind of this stabilizing force. And the paper is kind of still ongoing, so there's a few next steps that I have in mind. Right now, I've just looked at the selling pressure. I would like to look at buying pressure. I'd also like to look at kind of other forms of consumption and see how they stack up with the Edgar measures. And then, of course, there's always more robustness that could be done around the timing and the return measurement and things of that nature. But this concludes my presentation, so thank you all for listening and look forward to your questions.